Good morning or good afternoon, everybody, and welcome to today's webinar on alternative income documentation. So as questions come up, as I'm sure they will, please go ahead and use the little questions tab and ask them. And I will go ahead and ask the speakers on your behalf. Also, after the webinar, we will be, we'll have an additional time to ask any additional questions that may come up. So with that, I will turn it over to today's speakers. Take it away, Rob.
Hi, my name is Rob Taco. I'm the regional manager in New England, and thank you all for joining today.
Awesome. Janice?
Hi, everybody. I'm Janice Chernitsky. I'm at corporate in San Diego, California. I'm an account executive and loving every minute of it.
Thank you. Nicole?
Hi, everyone. My name is Nicole Truppi. I'm the Northeastern Regional Operations Manager here at LendSure. Looking forward to going over some scenarios and some helpful tips and tricks for you today.
Awesome.
All right, I'll start. So a little bit about LendSure. So LendSure was founded in 2015. We're headquartered out of San Diego, California. That happens to be where Janice is joining us from today. Nicole and I are in the Warwick, Rhode Island Operations Center. We also have another operations center in the east in Atlanta, Georgia, Salt Lake City, Utah, Ohio, and Missouri as well. We've been securitizing loans since 2017. We have a very highly experienced management team. Well, what does that mean? So if you've been in the business at least 20 years, you may remember the former accredited home lenders. Many of our executive management team came from accredited home lenders. So we are very experienced in the non-QM arena. We're lending currently in all 50 states. You'll see that New York is a lighter shade of green. That is because we do not have our residential license in New York, but we can lend on business purpose loans only. But all other 49 states we can lend in. Okay, so what do we do? So I talk to a lot of brokers, and typically I start off with what do we not do? So what we don't do is Fannie Mae products or Freddie Mac products, agency products. They are also known as FHA and VA. But what we do offer, so non-QM is basically on the edges of conforming. So what does that mean? Typically, that means there's potentially an income issue. Okay, that's most commonly what non-QM is. And that's where the bank statement loan comes in for self-employed borrowers, and that's where asset depletion or asset qualifier, and we're going to talk about those in a separate slide, are very popular. And we also have more flexibility on income calculations. You'll see there that we go as high as a 50 debt ratio with no additional pricing adjustments. We have a great 10-year IO, 40-year fixed rate program. So that's a fixed rate IO for 10 years, and it's a 40-year amortization. We offer for career professionals less than 2 years self-employed. An example of this might be a commissioned auto salesperson that has only been in business commissioned for 1.5 years, 1099. And then for a half a year, they become a licensed insurance salesperson. We can help that type of borrower who's been self-employed less than 2 years. We have construction loans for investors. This includes both ground up constructions as well as fix and flip for investment properties. And we offer expanded product types for properties. Obviously 1 to 4 unit, which is considered residential, but we also offer 5 to 10 unit availability as well. Non-warrantable condos, condotels, even condos in litigation. So all of that falls under the non-QM umbrella. Rose?
Bank statement loans. So these are amazing, and I do think it's one of our top products because we're very flexible. We use our common sense to underwrite these. So we can use business or personal bank statements. And if you've ever, if you're on this call and you've ever tried to use business or personal bank statements, or sometimes even mix them with other lenders, you would find out that they are not very keen on doing that. But we really do try and see this holistically to try and get your loan to work as long as it makes sense. So business bank statements, deposits are primarily business related. Obviously, everybody starts their business differently. I've had borrowers who started with their personal accounts and then later on opened up a business account, right? And I just had one a few weeks ago. It was a daycare. And we had to use some deposits in her personal account that came from the YMCA. So it made sense for us to use that personal account plus the business account, right? So anyway, withdrawal activities, also business related. Typically, you're going to see a business paying a business, expenses through their business account. And the commingling is less likely because they are using it more as an exclusive for business purpose. But personal bank statements, you could see all sorts of things, right? Deposits could be from different people for different reasons. Maybe their mom paid them back, so it gets a little trickier, but we are able to kind of figure that out if you help us, right? If you ask the right questions. So LendSure gets creative this way, and we really do try to understand. Did they open up a business account in the mid, maybe you have a 24-month bank statement program and we use 12 and 12, right? It's all about understanding. And I think that some people shy away from a bank statement loan because other lenders are just rougher on the income. But we really we want to understand it. And that's what your account executive is there for. Talk to them, call them up and say, look, I know they didn't do things the way maybe we wish they had, but that doesn't necessarily mean they're not making good income on their bank statements. So you could ask something as simple as, how do you earn your income and where do they deposit it? Out of what account do you pay your business expenses, right? And that will help you, and help us understand what we can use as income.
Mark says, I like the question, how do you earn your income and what accounts is it deposited to? I know that, Janice, I remember several instances. One with that was a musician that the loan didn't work at first because they were only looking at bank statements or income from one. And then asking some probing questions, it's like, oh, okay, there is a lot more. We just have to be documented a little bit differently. And I'm getting a couple of questions about, yes, this is being recorded, and yes, you'll have a copy of the slide deck. Look for an email about an hour after the presentation ends, and it will have a link to it.
I think that's number one on the top of the list for the most commonly asked question. Is it being recorded? And will I get a copy of the slide deck? We get that every time.
Every single time.
Hey, Rob, do you ever watch the recording yourself?
No, I don't.
Me neither.
And as far as the pre-qualification process for the bank statement product, it really is a four-part process, and really just diving into deeper of what Janice just said. So we do receive the 12 or 24-month bank statements. To the previous slide's point, it can be personal, business, or a combination of both if needed. And we also have our business owner, typically our borrower, fill out a self-employed questionnaire form, or an SEQ, affectionately known as. And this is where the borrower actually tells us about the business. How do they have their deposits? Well, I get deposits in Venmo, Zelle, there's definitely some debits, there is some cash involved. How many employees do you have on payroll? Do you pay rent for the business? Things of that nature. So then it really helps us understand the bank statements even more. So we understand where the ebbs and flows are, where we're looking for the payroll to come out, we're looking for rent to come out, etc. in that step number 3. So we do have a very highly experienced underwriter analyst who looks at these before we are even disclosing. So you know what your income is, we understand what the expense factor is, and that is how we determine the qualifying of the self-employed borrower.
And if I could add, just from a sales perspective, so in speaking with brokers, when the business owner fills out that self-employment questionnaire, there's typically a little bit of a back and forth with the broker and the AE to really get an accurate depiction of those expenses. Sometimes there might be some confusion on filling out that Word document. We don't ask the borrower to include themselves in their payroll. We ask them to include any employees that they might have, whether it be full-time, part-time, or contractor. So we may ask you to go back to the borrower and just maybe fine-tune that. That self-employment questionnaire is very important because not every cost structure is the same for every business. So a very small business, a one-person operation would have a very, very small or low cost structure, very little expenses. Versus a restaurant, which is very, very high cost structure. So I just wanted to add that point about the SEQ.
Rob, Renee wants to know what the minimum expense factor is. for
So
a
that's a
business
great
with no
question. And
employees?
I think that brings us to the next slide, but typically we go as low as 10% on the expense factor. And many of our competitors will default to a 50% expense factor, which means that of those gross deposits, they're only using 50% of that income. So, and we would use 90% if we were going as low as a 10% expense factor. So every self-employment is very different, as is every cost structure like we talked about. We know it's not one size fits all when it comes to this expense ratio. So that expense ratio is a percentage of the operating costs that are deducted from that average monthly income of those deposits. So in this example, I'll just take the slide, if you don't mind. If you had $10,000 of average monthly deposits and we assigned, let's say, a 25% expense factor for let's say a relatively small business, there's only a couple of people operating this business, we're using 75% of that $10,000 or $7,500 in qualifiable income. So we're only deducting 25% in that case. And by contrast, some of our competitors may use a 50% default expense factor, in which case that's a big difference. That's $2,500 less income monthly, which could affect their buying power to buy a new home.
Okay. And Mark, you can find the self-employment questionnaire on our LendSure website, lendsure.com. Just go to broker resources and you'll find within there forms, and you'll find the LendSure self-employed questionnaire.
And your AE can send them to you as well. And I wanted to kind of point something out because some of you on the call might be wondering. I know some competitors will go below the 50%, but they require a CPA to tell you that their expense ratio is lower. We do not. So you see this example, fixed versus a variable expense ratio. So if you go to our competitor and they take away 50% of your income, congratulations, you have half of the income to qualify, basically. But if you go to a variable expense ratio and we want to understand, we want to make common sense decisions, we understand your borrower works from home, doesn't buy anything, doesn't pay anybody. Well, their expenses are going to be in the low range of 10%. So with this example, you're going to, if your average deposits were $10,000 on one, you'd get 5,000 qualifying in income. With LendSure, you'd get 9,000. That's a big difference, right? So, just like the little doggy on the side, you can close more bank statement loans with LendSure because we do.
I love this.
Yeah.
Oh, I'm sorry.
It's okay. I love the dog too.
I love the dog, but I love the sarcasm about congratulations. We're only using 50% of that income.
Guys, Keith has a question. Are businesses in high expense categories allowed to use the default expense ratio of 50%? For example, if a contractor who is purchasing a primary residence with business bank statements.
Yeah, so we don't actually have a default expense factor. We will assign an expense factor to each individual bank statement. And I say bank statement because we've actually done loans where a business was owned by two people, and we did both loans for both owners, and I will tell you those loans looked very, very different. The expense factor may have been the same for the business, but just the other overall qualifying was different. So to your point, Mark, that would be an expense factor based on your borrower and your borrower's business specifically, which is why we look for the trends in the bank statements, but we also rely on that self-employed questionnaire form.
Okay, great. Luke, I think that answered your question of how do you determine the expense ratio. Let me know if you need more clarification on that.
So again, going into what we're actually looking for in the bank statements, are the deposits consistent every month? What percentage of the business is owned by our actual borrower? Because we would apply the percentage of ownership as well as the expense factor when determining income there. Can we find evidence of the self-employment online? Sometimes, you have a general contractor who has a general contractor license for the past 20 years, but we see online reviews that in the past 24 months, so that immediate 2-year history, our borrower is receiving Google reviews and is working these jobs in the the bank statements confirm this as well. What do the withdrawals look like? We talked about this a little bit in combination with the SEQ. We use the withdrawals as well. What is the overhead of the business? What kind of trends are in the business? For example, when we have a self-employed landscaper, we understand that the winter months may be slower than the summer months, but we're looking for 24-month bank statements so we actually identify and see those trends. Not only are they reoccurring, but we are also seeing that we are making the same, if not more money year after year. So again, how long has the borrower been in business? Are there any overdrafts or NSFs that we need to address and have a conversation about? And then do the names on the bank statements match the application that matches the documentation that we're getting for self-employment? So for the most part, we are analyzing our bank spread with not only what we're actually seeing in the bank statements, but also that self-employed questionnaire.
Okay, and Jody, just to clarify, Jody says, can we send in for you to calculate the monthly income? So yeah, it's LendSure that does all this heavy lifting and does all the analysis and does all that, right? You guys don't.
But we need that self-employment questionnaire to accompany the bank statements to get an understanding of the cost structure, but absolutely.
Correct. And I wanted to point something out because this brought something to mind that even though we are looking for consistent deposits each month, because we do think about what the borrower does, just like Nicole said, with, you know, somebody doing landscaping and having obviously, you know, winter months being slower. I had a loan for someone, he told me he had gone to 5 different banks and they had turned him down. Now he had been doing fix and flips. That was his job. That was his business for 20 years. His deposits were very sporadic, but I had 2 years worth of that. And did it take a little extra TLC to piece that income together and understand what his expenses were? You bet. You know, because if you're buying homes, fixing them up and selling them, you're going to have some expenses, but and sporadic months, right? But we were able to make that work. So don't be discouraged if it makes sense for what they do for a living and we can see those trends, like they're going to be consistently getting that income, whether it's sporadic or not. You have some hope there. So.
And I bet your self-employment questionnaire was very detail oriented because we ask, you know, how do you earn income from your business? So in that case, because it was so sporadic, Janice, I'm sure they had to elaborate more on that so we could really get an understanding of it.
They did, and I actually stepped in at that time. My loan officer had ended up in a hospital, and he asked me to call the borrower myself, and I was able to get invoices, or not invoices, settlement statements from the purchase and sale of each property. So it took a little more than the bank statements, but upper management was able to make that work. And I knew it would, I just needed to document how. And like I said, it took a little TLC, but we made it happen. And not to brag, but that borrower was so happy with us that he recommended 4 other borrowers to his LO, and we closed other bank statement deals that were much easier. His was the hardest. Yeah, the other ones were a breeze, but you know, that kind of thing is if you just at least give it the attention it deserves, even if it takes a little bit longer to get an approval, it can make all the difference, and it leads to referrals.
That's one of the.
I'm sorry, Rose. I just want to add one point. So clearly we're spending a lot of time on bank statements and for self-employed borrowers. Folks, understand, you know, the self-employed borrower is the same. This is the same A-paper borrower you see every day. They're just qualifying in a different way with us through non-QM. So these borrowers typically have the assets to put down. They have very high FICO scores. They just have, you know, creative income tax preparation. And for that reason, it affects them when they go to qualify for a mortgage. But, you know, keep that in mind. That's a bank statement loan, even though they have 760 FICO scores and 30% to put down, but they can't qualify from an income perspective. That's a non-QM loan. That is the real nuts and bolts of a non-QM product.
Thank you. Yeah, I was just going to mention to Janice that that's one of the comments that we hear all the time when we get reviews, when we get feedback on social media, the attention to detail, how we can roll our sleeves up and really use common sense to get to the root of the person's income.
This is true. This is very true. I'm glad it happens to more than just me.
And speaking of sporadic borrowers, everybody on this call knows a realtor friend. think about that. How many of our realtor partners are closing the majority of their volume, say March, April, May, takes the summer off and then closes it September, October, November, maybe even some of the brokers on this call. So think about that, not only your borrowers, but even partners that you can help. And one of our scenarios, so we're throwing some scenarios out there. These scenarios are loans that we have actually closed, and everybody on this call has either done it themselves or have been involved in these loans. So for this one, we like to think of it almost like a hybrid. We were able to use a bank spread in which the musician was receiving royalties from their label or their recording company, and they also had a contract that we were also able to use. So we used a combination of the bank spreads to show what income they had been receiving, the self-employment questionnaire to just the borrower to tell us exactly what their expenses were. In this case, there weren't a lot of them because the record label usually took the expenses on themselves. And we were also able to see the royalties contract that they were set to continue for a certain number of years, a certain period, and we were comfortable with that income.
Now, before we go on to investor, Kelly has a comment / question. How do you handle first responders income? Their extra duty is all 1099. Will you look at them like a self-employed and use bank statements as well as their 1099?
So sometimes we'll use bank statements to show, once again, a trend or a pattern and the consistency of using a shift differential or overtime, or sometimes they are chaperoning the middle school dance as a fire marshal. We've seen them all. A lot of times we can use just the end of year document, so your W-2 and your 1099 in combination with a current pay statement or a pay stub. Sometimes we would need to request the 12 to 24 months just to identify that trend, but for the most part, we're using what we call alternative full documentation, which would be the 1099 W-2 and pay stub.
And I'm getting a couple of different questions on when do we need 24 and when do we need 12 months?
So we do have different qualifications, whether it's LTV, FICO, et cetera, and what you're looking to do, whether it's primary versus income qualified. So that would be a great question to ask your AE with the specific scenario. Sometimes 24 is required on certain scenarios, and sometimes it's really your borrower's preference.
I always, as an AE, I always say, if you can get 24, get them. If we don't need them and or they don't look as good, we can typically drop them. But for like 90 LTV, you always need the 24. So keep that in mind. But gosh, if you just ask for the 24 up front and we can get them an eighth better pricing because that comes with a better pricing, then great. If the 24 months don't look great because maybe the year prior was kind of shaky, and we don't need it, we make it go away. And that's something, I don't know if we're gonna have this on the slide, I don't remember, but our pre-underwrite is meant for that. We get that kind of stuff out of the way before it goes to our official underwriter. So that's what your AE and their team is for, to kind of get the stuff situated. Now it looks nice and perfect, then we send it to the underwriter for approval. So that way, nothing comes back and bites us later. True.
Yeah. And we have a number of ways to qualify that income, whether it be 12 or 24 months. We might take a 6-month average in the most recent 12 months. We may ask for 24 months and only use the most recent 12, but we want to go back 2 years and look at the deposits over a 2-year history. So lots of flexibility. In some cases, by exception, I've seen us use a 3-month average of the most recent 3 months of income on those bank statements. And that's for a particular business that's just starting to come into its own and really just starting to generate high deposits. And we understand that, you know, there's got to be a story around that and typically a letter of explanation, but we have done that on an exception basis. So lots of flexibility there on the bank statement products, I think is the major point.
Okay, great.
So another option is kind of switching gears to our actual type of borrower, which would be an investor. Sometimes investors know that their property can perform and they don't want to provide income docs. We have a DSCR product for that. If they do want to provide income docs, we can use both full doc, whether it's the alternative we were just talking about with the end of year documents and pay stubs, or we can go with actual tax returns themselves. Same thing on the bank statements, even on investment properties, we can qualify investor income qualified and use 12 or 24 months bank statement spread. The DSCR, or a debt service coverage ratio, is truly just your rents divided by your full PITIA payment. We want to make sure that that DSCR ratio is 1 or higher. Right? So in essence, the property is not losing money. Sometimes we'll start a loan as a DSCR and the market rents will come in not as we anticipated and the DSCR falls below that 1 threshold. Sometimes we can make it work with an exception, but sometimes we might flip that to investor income qualified. But we definitely have some flexibility there. And then the big one for investors right now, fix and flip. There are properties that have been on the market since October, November, and there are no buyers for it because it does need significant work. So fix and flip is no income documents required either. We really just want to see what that scope of work is going to be, what the anticipated return will be after the purchase and the renovations done. So again, going right on into full doc and calculating that rental income, Fannie Mae and Freddie Mac will typically use that Schedule E income right off of your tax return. We have flexibility here to use 75% of leases. We have the ability to do a bank spread on rental income that's received when your borrower owns, say, 6 or 7 rental properties in general. Typically, we take our rental, whether it's a positive income or maybe a rental loss, and that actually affects income for us, not debts the way that Fannie and Freddie qualify conventionally. So that is huge that we apply that to the income and we don't add it as a debt.
That results in about a 20% lower debt ratio. And I believe, Nicole, you're going to demonstrate that here and we have it on display for you.
Yeah, so I wasn't going to go through the numbers. This is truly the income calculation and seeing the difference like Rob was talking about and actually seeing the different income that we have and it's coming from the Schedule E versus how we're actually able to calculate it.
I love this. I mean, keep this in mind. Don't forget that this could literally turn your deal around and we're going to love it. It's a full doc deal. Wow, look at that difference of DTI.
That's a huge difference, right? That's a huge difference when you subtract those rental losses against the income versus adding them as a liability. You see that it's a 30% DTI versus 48. That's huge.
Yeah,
That's
you might have closed, 5, 6 loans for your investor, and now they're getting to that point where they just don't qualify full doc conventionally, but they would with LendSure. And just nice to mention, we don't have a cap on the number of properties they already have financed. So, we've done loans with people who have 35 properties financed, and it's okay. In that case, I would recommend the debt service coverage loan for ease of use, but you never know, we might underwrite it anyway this way.
Yeah, and this is kind of goes back to what I talked about when I opened the call, and I said, part of the reasons for non-QM bank statement loans, asset depletion, asset qualifier, which we're going to talk about, but also flexibility in calculating income. And this is exactly the example right here with how we calculate, a negative rental income or a net operating loss, if you will, from the rental properties. So good stuff.
Great. And then this webinar is being recorded, and yes, you will have a copy of the slide deck. Just look for an email about an hour after the webinar ends, and we will go ahead and include a link to those things there. And I have a couple of questions that are very specific. I want to give you as much complete and accurate information as possible. So we can address that offline. I'll connect you with an account executive. If you want an answer right away, when you get that email from me, just reply. It'll come right back to me and I'll get somebody on it immediately.
Excellent.
So again, going into the debt service coverage ratio and how that is actually calculated. When a DSCR is over 1, that means that your rental income is greater than the actual PITIA that's required with our mortgage loan. When a DSCR is less than 1, that means that there is not necessarily enough cash flow from the property. We will go as low as a DSCR of 0.8 with senior management approval. And again, with a loan that it makes sense to do so, right? You have an experienced investor, leases are ending within 30 days of the purchase. We know that the experienced investor is going to likely increase the market rents or increase the rents on that property, things of that nature. But like we said, if the DSCR for some reason doesn't qualify, we always have the option to flip it investor income qualified if needed. Or we also have a no ratio program for the DSCR. That means your DSCR can come in at 0.5 with an experienced investor who knows what they're getting themselves into. We will do that with no DSCR, so we're not calculating the ratio. We just have to meet some FICO and LTV requirements in order to do so. So like that last bullet, below 1 DSCR is reviewed as on a case-by-case basis, but we would definitely love to see your scenarios.
And you know, it may sound counterintuitive. Why would an investor buy a property that is generating negative cash flow? It could be that just the leases in that area for that property are on the low side, or they're going to increase them, or could be the market rents are on the low side, but it's a great property to buy in a great location, and there's going to be market appreciation in the value of the property. So that could be a big reason for it. So never really know what the motivation is there, but it does come up, and that's why we have that no ratio product with 30% down.
Okay. And I've got a question. If they don't have a mortgage on the property, but just this year started renting the property, can I use the net income from the rental income?
That would be a case-by-case scenario. We would like to see the collateral, what your current leases are, the strengths of the borrower. So definitely reach out to your account executive.
Okay.
All right, so this is what your Form 1007, so Form 1007 looks like on the appraisal report. This is required for any of our investment properties, and it actually gives you the subject property. It gives us 3, some appraisals will give us up to 5 comparables in the current market, so in the pertaining area, and what type of rents those comparables are getting. It will also say if the property is currently rented, what those current leases are, goes into the comparables, right? They're all a C3 condition. They all have the same bedrooms. They all have the same bathrooms. And then the appraiser themselves gives us their analytical market analysis so that we know what the projected market rents would be. And again, we're also taking into consideration what the lease currently is. So one thing that I do want to mention on this is that we can do a Form 1007 for both long-term rents. So that is your 1-year lease. They pay monthly and they stay there every single day of that year. We can also qualify using short-term rents. Think Airbnb, VRBO. Some people like to rent it individually. We have a lawyer who rented his beautiful house by the ocean every week from May through September, and we were able to review those leases, and this Form 1007 also made mention of them. So this is the actual form that we would be requesting, and just an example for you.
So if you have a DSCR loan, the first thing you should look for on your appraisal is this form, because that's the magic number, what the appraiser is going to write in there, especially on a purchase, right? So if it's leased already and it's a refinance, we usually use the lower of the two, but with proof of rents received, we could use higher rent. So, but I'm just wondering if anybody's, flipped through their appraisal and looked at this, called their AE and goes, it cash flows. Like, we got the magic number. It's like a scratching ticket, right? We win.
But I'm going to put my operations hat on for a minute and say that also what's very important in calculating that DSCR, right, to make sure that it's a 1-to-1 or higher, is the taxes and insurance on that property.
Yeah.
Right. So the taxes and the insurance, and getting a pretty accurate figure of what those annual taxes are, maybe from the town or the city, and then an idea or an estimate of what the HOI is on that property as well, because that plays into your DSCR. And if we don't know those numbers up front, it's almost like a crapshoot, right? If that DSCR could come in below 1 when we do verify those numbers. So that's very important. Your account executive will reinforce that with you and really go over that with you when you bring in the deal.
Here's a question I don't think I've ever heard before. Is a board house eligible for DSCR? I have a client that rents rooms instead of the whole house. I would think that's very popular in college towns.
Yes,
At this time, that would be a case by case, but I have not seen us do them recently.
I would agree.
Okay. Will you allow for short-term rentals? I am in a resort area where most of the rental incomes comes from late spring through early fall months.
Yes, we absolutely do short-term rentals all day, every day.
All right, fantastic.
I think this is Janice's slide, but we were fighting over this one because it's such a great slide.
Well, I'll talk a little, then you talk a little, but ease
All
of
right.
use, right? I had kind of mentioned this already. If somebody does own a lot of properties, underwriting their loan, right, and asking to see a debt to income ratio, it's going to be a challenge. One we can take, but why not do something that just focuses on the subject property and the cash flow? No other income documentation is needed, right? And I'll be honest, I've priced out loans with income and with just DSCR, and our rates are lower on DSCR right now.
They are.
So yeah, so it's fantastic, and I think that that's something we should focus on. But Rob did want to kind of talk about this one too, so he can.
I did. I wanted to say if you have a DSCR right now and you bring it in, we could easily close it by month end, because really the only thing that takes time on these types of loans is the appraisal. It's waiting on the appraisal. If we know up front that it's positive cash flow and it's 1-to-1, and we have a good idea of what that market rent is, perhaps by looking at Zillow, or maybe if it's a refinance and we have leases and we know it debt services itself with the leases, we want to bring that in, get an appraisal done and close it, because this is really, no employment, no income type loan. The property debt services itself, the loan is approved. So, it's really easy, and you don't need mortgage ratings on other properties. We do not need to verify taxes and insurance on the other properties. We do need an REO on that IRLA, on that 1003. It's got to be filled out with an REO on the other properties. And, as Janice mentioned, we'll close quickly and multiple loans for the same investor.
Okay. What about, how do you deal with rural areas where there is no 1003 comparables? I recently had a property in a very small town that did not have any rentals that were comparable to the property.
That would be an instance where it would need to make sense. Is it rural, absolutely nobody's visiting it? Or is it rural, we are looking at a condo at the bottom of a ski mountain, so they're only going to be occupying it or having tenants occupy it for, a quarter or two of the year. So that would definitely be a case-by-case scenario. Have we done rural investment properties before? Absolutely. But it does need to make sense. So definitely feel free to throw that specific scenario out to your account executive.
Yeah, and I would only add that rural and DSCR, if it's truly rural, it might be at a slightly reduced LTV as well. So I just want to point that out. And I think investors know that. Savvy investors that are buying rural investment properties, they're pretty familiar with that they might require more down in that case. Okay, so this is my slide again, continuing along debt service coverage ratio, or our investor cash flow program. I'm just going to go over some of the highlights with you. I'm not going to read this entire screen, but I do want to point out some of the highlights. And first foremost, 85 LTV for purchases. That's huge that we go as high as 85 LTV. 70% LTV with no ratio, as Nicole discussed on prior slides. Up to $3 million. I know Janice likes the sounds of that because she's out in California.
I sure do.
Where those come out, that's an everyday occurrence that she gets $3 million loans, no lie. No limit on the number of properties owned, so that's huge. We can finance up to 10 properties for one investor, but there's no limit on how many they own. And then last but not least, obviously non-warrantable condos are allowed. We've even done condo tells as DSCR. But the last point is very important. Let's say you're just under 1 and you're at like a 0.90. We can put the borrower into that great program I mentioned earlier, the 10-year IO, 40-year fixed, where the rate is fixed for 10 years, but it's an IO payment. And that interest only payment is going to bring up the DSCR, and we're going to qualify that DSCR on the IO payment. So that's huge. Instead of principal, interest, taxes, insurance, and the association fee, if it's a condo, it would be just interest, taxes, and insurance, and the association fee if it's a condo. So we oftentimes use that, or a buy down. We can also offer a buy down. For example, if the borrower pays 0.5 point to LendSure, we could buy down the rate 0.25%. That will help not only lower the rate, but it lowers the payment, and it also increases the DSCR. Okay, so Rose, any questions?
Yeah, I have actually a couple of different questions on owner-occupied DSCR. So it's a town, they own 2 townhouses, they live in one, they rent the other, or they have an apartment building and they're renting 3 of the 4 units and living in the 4th unit. How does that work?
That would not qualify for
Correct.
a DSCR loan. That would qualify as a primary.
Right. DSCR is for investment properties only. We can lend on 1 to 10 units, but the borrower cannot live in the property.
Okay. And does LendSure offer non-recourse option to LLC held rentals?
Not to my knowledge. That's one we should take away, Rose. I'm not 100% sure. And Nicole, Janice?
When I hear non-recourse, I think of our reverse 1031 exchange, but I don't know if that's what they're referring to.
Yeah, not 100% sure.
Because I do know reverse 1031 exchanges have non-recourse language, but I'm not entirely sure if that's what's referred to. We do close in reverse 1031 exchanges.
And we do close in LLCs. In general, just a general answer, we absolutely close in LLCs for title all the time.
Okay, great. And question, did you say condos qualify with DSCR?
Yes, absolutely. We've done them. We've done them on the panhandle of Florida. We've done a lot of them down there. So yes, absolutely. Yes.
Okay, great.
Right. That would be, we would need a 1-to-1 DSCR ratio on that. We are probably not going to entertain below 1 on a condo tel for that DSCR.
They usually cash flow.
They usually cash flow. That's a good point. Yeah. All right. So just really quick, conforming versus LendSure. I think we pointed this out. Fannie Mae, max number of finance properties 10. LendSure unlimited. Unlimited minimum FICO score 720. LendSure is 680. As I mentioned, non-warrantable condos, condo tels. We can help with those. Conforming Fannie Mae, there might be a lot of restrictions with Fannie and Freddie on that. And then closing in an LLC, investors and foreign nationals love closing in a limited liability corporation. So we absolutely will do those. It's very common, more often than not, we are closing in an LLC. So. Okay.
All right. Well, Rob kind of introduced foreign national right there at the end of his slide. Thank you very much. Foreign national, what can I say? It's a niche product. And, if you're looking, hey, how can I get more loans in the door? This is a great one to try and focus on as well. Foreign nationals are people who live and work in a foreign country. Just to kind of keep that in mind. A non-permanent resident would be somebody that is allowed to live and work here on a non-permanent basis, which we also have loans for. But right now I'm focusing on somebody that lives and works in a foreign country. And for income, this is really cool. A lot of our competitors only lend on investment properties and they only use DSCR for foreign nationals. We actually will allow for income documentation from a foreign country and do second homes. A lot of these foreign nationals aren't just buying them as investments, but they're also buying them because they want to come here maybe in the summertime and have vacation time here. So we can close as a second home. If they're employed, what do we ask for? Tax returns? No, we only ask for a letter from their employer with year-to-date income in the past 2 years. And I always suggest that if they speak English at their job, they should write it in English so you avoid having to translate that document. If they're self-employed, which of course from our bank statement loans, we love self-employed borrowers, so we have an option for them as well. All they need is a CPA letter from their CPA in their foreign country, or their local accountant on their letterhead. that verifies their personal income for the past 2 years and year to date. And now you can get a second home for a foreign national.
Okay, great.
Or if
go
they're
ahead.
buying a rental property, you can go DSCR and avoid all of this income verification requirements, right, Janice?
You can, or you could start with this with income qualification. If the DSCR ratio works, you switch it over to a DSCR. If it doesn't, you already have an approval with income. There's a lot of creative things we can do.
Yep, absolutely.
So some of the qualifications for assets for our foreign nationals, we will be looking for 12 months reserves. A big thing about reserves are they can stay in the foreign bank account. The reserves can stay in the foreign bank account. Typically, we want to see any funds that are being used for closing costs or down payment coming over to a US domiciled bank account, but we are able to use reserves for the foreign. So we understand that 12 months is a little bit of a higher reserve requirement. But again, if they don't have to move that money, our foreign national borrowers are very amicable in just giving us those foreign bank accounts. Gift funds are acceptable with a senior management approval, and they are supposed to be transferred to the US domiciled account. Sometimes our foreign national borrowers will actually wire the funds directly from their foreign account to the settlement agent, as long as the settlement agent will accept foreign incoming wires. So that sometimes is an ease of assets, but if they are going to be sending it to themselves, we would like to see that typically within 30 days of closing. And business accounts are eligible as well as personal accounts. Even we've seen Canadian borrowers give us retirement accounts for reserves and things of that nature.
Okay, great. And I got a couple of questions on who orders and pays for all these translation services.
Translation services are a requirement of the broker borrower.
Okay. And then I've got a question here about a US citizen, but living in another country, has a foreign address, but they're getting US income. Would they be considered a foreign national?
So we would deem them somewhat of a hybrid. So we've definitely taken those scenarios in, and we have to roll up our sleeves, like Janice mentioned, to see exactly, does this make sense and how can we make it work? But we have certainly done those borrowers before.
Yes, very much so.
Great. And I've never heard this one before, but do we offer, I'm sorry. Oh, I'm sorry. Here's one.
The answer is yes. Yes, we offer.
Going back to DSCR for a moment, do you report credit if closing under an LLC?
We are going to pull credit for the individual borrower. If you would like the loan to be reported in the LLC under the LLC EIN versus the borrower's individual social security number, we can do that, but we will be pulling a credit report for the borrower on our loan.
To qualify, yeah, but make sure you tell your AE, I don't want it to report on the personal, and they can request that and use the EIN number for the business. I've done those. They're like, are you sure? And I'm like, I just need to request it and you should be okay.
Yeah, that's huge. That's huge. Yep.
Is there pricing difference for closing it as an individual versus closing under the corporate name?
No, there is not.
Do you allow PTINs for your product? And I wasn't sure what PTIN was, so I asked, and he said, no, PTIN is a form of an accountant. Some investors do not allow PTINs, some do.
If you're referring to the IRS acknowledged tax preparer, we have accepted those letters before when telling us kind of self-employment information, but I think that would probably be a case by case, so definitely reach out to your account executive.
Okay, what about if the borrower is a foreigner and doesn't have a social security number?
That's typical.
They don't need one. Yeah.
Yep.
Okay, great.
Very common. That's where the alternative sources of credit come in from their home country.
Okay.
Okay, asset depletion, asset qualifier. Our underwriters love to underwrite to this. So this is another form of income to debt service and to qualify. And this is typically a borrower with excellent credit, but they don't have steady income. And we may be able to use their assets to qualify and convert that income to qualify into a debt to income ratio. And we can use this in conjunction with other income. So if they have a high net worth of investable assets and they're self-employed, we may use bank statements, and we also may use asset depletion to help qualify in that DTI. So an example of this, we have two types of asset depletion for qualification. The first one is called asset depletion, where the draw period is based on 120 months. In other words, we take those invested assets, we divide by 120, and as long as those post-closing assets are at least 500,000 or greater, then they would be eligible for this asset depletion program where we divide by 120. However, we do make exceptions if it's less than 500,000 post-closing with a FICO score of 720 or higher. So that's not a hard and fast 500,000 post-closing that we would asset deplete. Now, we also have another program for even the higher net worth client that has even more investable assets, where we can double the qualifying income, because if they have gross assets post-closing now of 500,000 or the loan amount plus 60 months of debt service, and I know you're probably like, what? That sounds very confusing. Your account executive will work through that with you. Then we can divide that income or those assets by 60 months to come up with an even higher income number monthly. And I think we have an example on this on the next slide, Rose, for everyone to see. So for example, cash and equivalents, we will use 100% of that type of asset, okay? Stocks and bonds, we use 80% of that because it's invested, and if you sell those funds, let's say you had to sell those to liquidate them, you could experience some sort of 20% cost or expense associated with that. And just like retirement funds, we use 70%. So in this case, the bar is 525 in cash and equivalents. We'll use 100% of that, and that's what you see on the far right for the qualifying amount. Stocks and bonds at 80% is 200,000. Retirement funds at 70% is 315,000. All total, that's $1,040,000. If we divide by 60 months, in this case, the borrower is eligible, that's $17,000 a month in monthly income to calculate a DTI. And if it's based on asset depletion and we divide by 120 months, it's a little less than that, right? It's 86, 66 a month, still a very high number of monthly income to help. And then down at the bottom, and I'm not going to really read to you, but there are LTVs, very aggressive LTVs, especially on purchase transactions, where we'll go to 90% on a primary and 80% on a second home using the asset depletion or asset qualifier program. I'm sure there may be a lot of questions on this, but it's pretty straightforward.
Okay. On this, how do you decide which one they can use?
So it really depends on those post-closing assets after their down payment and closing costs. What are they left with reserves? If it's just north of 500,000, then we're going to divide by 120 months and use that lower figure. However, I believe Fannie Mae, when you do asset dissipation like this, they divide by at least 240 months, and the borrower in many cases may have to be retired in order to do this calculation, and it may only be used for retirement funds where they will do asset dissipation to convert those assets to income. For us, we're saying we'll do this for a 30-year-old borrower, and we'll convert their cash in cash equivalent at 100% of that asset and use that as a qualifying amount, and then divide by 120 or 60. It's huge. It really is big.
Okay.
But please don't forget, we can mix this. So your borrower can have a job. They could be a self-employed borrower and have a business account. And there's a lot of things we can do to get the income to work. So I always say, show me your assets, because I've had loans where hey, I'm just at 54 DTI, and all of a sudden they go, oh, well, look at this retirement account with $600,000 they didn't want to show me.
Right.
I just added a bunch of income and now they qualify. Sometimes it's easy as that.
Yeah, that's a great point. Sometimes loan officers may not ask about additional assets that are there. They just didn't ask because they feel like, oh, okay, you gave me, you gave me sufficient assets for the transaction for, let's say, 20% down and 6 months reserves and closing costs. That's all I need, Mr. Borrower. Well, if it's an exception or it's coming to us for an exception, or we need to stretch that DTI, those additional assets, to Janice's point, are very important. They're a very integral part of that debt ratio in helping them qualify, because we can convert that into income.
Okay. Can a foreign investor use asset qualifier / depletion?
Not typically on foreign assets. If our foreign national borrower has, say, a JP Morgan Chase or Wells Fargo, Charles Schwab account, possibly, but not typically. But definitely throw that case-by-case scenario out to your account executive.
If you're doing cash out on this program, do you use the cash out as asset qualifier?
Sure can, and
Yeah.
have done it multiple times.
Flexibility right there.
We can, and we've done it even with like a bridge loan and a purchase transaction. So.
Okay. And Rick wants to know, why would somebody want to use the asset depletion if they qualify for more using asset or asset? I think he meant asset qualifier.
Most of the times it's just the balances and that 60-month debt to service ratio.
If the loan works with the least aggressive approach, we'll use that one. It won't make a difference in pricing or anything. If it doesn't and we have to go with the more aggressive, it has to meet that guideline. And sometimes it doesn't, although we can sometimes try and get exceptions. So.
Okay, let's talk about combining income types.
And we just talked about this one where we can use both bank statements and asset depletion. So this one was a fun one that we've recently closed, where we actually had 2 borrowers on the loan. One was a US citizen, one was a permanent resident alien. They did file US tax returns because they are US citizens, but both were actually living overseas. These particular borrowers were living in Italy. We obtained a housing history in Italy for the past 2 years. We saw and we received the 2 years tax returns with foreign income. Now you might be thinking, well, conventionally we can do that too. Well, the foreign income that was claimed the past 2 years was significantly less than what they are currently making. And we were able to show that the foreign income was obtained and claimed by our borrowers on the US tax returns the past 2 years, but we actually qualified off of the current contract that they had with this national sports team. So again, this is a hybrid borrower where they are actual US citizens and permanent resident that claim income on US tax returns, but we almost treated them as like a hybrid foreign national / US citizen. So it was great because conventionally the broker was just not able to get them the house that they were looking for. But with our hybrid income, we were able to present this makes sense scenario to senior management. We were able to close this, and they had already had an appraisal because it was a fallout. We actually closed this in 6 business days.
So this was my example in North Hollywood. This was an 80 LTV, $2 million purchase with 3 borrowers. 2 of the borrowers were permanent resident aliens, which really didn't affect guidelines much at all. But the biggest thing here is we used 3 different types of income to qualify. So even though we're at 80 LTV and it was a $2 million loan, we only used 12 months of bank statements for the husband, because the husband was self-employed. And that was a little bit of an exception, but we got it done because it was really good longevity of the employment and being self-employed for quite a period of time. So the business was well established. His wife received W-2 income, so that was basically full doc income. The bank statements was alternative income, and the mom was also on the loan. All 3 were qualifying to fit within the DTI of this $2 million loan. The loan amount was $2 million. And we used the mother's pension and Social Security benefits. So we combined all 3 incomes from all 3 borrowers to get them to debt service for a $2 million loan, which was an 80 LTV purchase. And all three were on the loan application in the same.
Okay.
So restricted stock units or RSU income, you may also be thinking, well, yes, I can do this conventionally. Conventionally has a lot stricter guidelines, looking for even more documentation. We're typically looking for tax returns, your current contract, and just the current balance of the RSU. But in this instance, they were actually going to be getting RSU as part of their total compensation package, and we were able to use the current contract. And even though the RSU for the current compensation was going to be much higher than what they had been receiving at their previous employer, we were able to use the actual current contract in combination with some history of receiving it already. But RSU income, right? Think of your kind of global conglomerates, if you will, JP Morgan Chase, Google, Facebook, or Meta, sorry. They are often compensating their employees with not only monthly income, but also with restricted stock units. So something to think about. And really what we want to leave you with are some key terms, some phrases, some scenarios that we've all closed before. So we talked about foreign nationals. We will do cash out loans. Typically the cash out in hand is about $500,000. We will go up to $1 million on those collaterals that make sense to do so. Non-warrantable condos and condotels, anywhere from a single family house up to a 10-unit property. We have a loan for that. Second homes, primaries, investments. We can do bank statements for self-employed borrowers. We can do construction loans from the ground up or fix and flip rehab loans for our investors. Bridge loans, we talked about 1031s and 1031 exchanges. Those are very investor savvy programs. Asset depletion or asset qualifier, like Rob has said multiple times here, interest only. Interest only has saved many a deals for us. Looking at you, Rob.
Very good, very important.
In land contracts. And again, those 1031 exchanges where our investors know the market and know how to qualify and run rental properties.
Why would we want to partner with LendSure? Oh my gosh. Well, first you get to work with one of us now. But
I knew you were going to say that. How did I know you get to work with me, right?
I don't, yeah, you do. Well, maybe if you're lucky, I don't know. But no, honestly, and I say this with my heart full, is that we really do care about your loans. We care about you. You know, you're the face, you have to talk to the borrower. So we have a great like pre-underwriting experience where, like I told you before, we're going to get the tricky stuff out of the way. We operate with flexibility. I think that what we've talked about today has really kind of made that a point. So I just kind of want to say that all the AEs are highly trained to assist you with structuring your files. You don't have to have the answer for everything. You don't have to underwrite the loan yourself. All you have to do is help us get the information, tell us what the situation is, and then we can collectively come together to figure out a solution. And that's, I just kind of wanted to put that front and center for you. That's one of the things is competitors, I've seen time and time again, and I promise you, I tell my ops manager this all the time, I get a lot of fallout loans. So people calling me, help, it fell out, they told me we could do it, they can't, and now I have, 2 days to close. And I'm like, oh my goodness. First thing I say is, can we get an extension? And because, 2 days to close a primary, that's almost impossible. But I see it all the time. And then I have a conversation and I say, hey, we have a pre-underwriting system. That's what we're trained for. Our teams are there to basically make sure your loan's going to close. So I think that that's something that's very, very valuable, that you should know. It's how we like to do things. So
Somebody at the door?
Not my door. But anyway, see, there it is. LendSure approvals are rock solid. So.
Yeah. Rose, is that, okay, I thought that was my slide, I'm sorry.
Oh, it's okay. Do you want to go back to it?
I know, I would just say that Janice touched upon this, when LendSure issues an approval, you can count on that commitment. All that really means is that plays into what Janice was talking about, that we do a fully vetted pre-qual up front to identify the exception right up front, so that the loan isn't 2 weeks down the road in front of an underwriter and then the exception is discovered and surfaced. That happens up front at the pre-approval stage. And that's what we mean by a fully vetted pre-qual. And that's where fallouts come in. When other lenders back out of your deal and leave you stranded, that's because you're too far down the path. And we identify that up front by asking a lot of questions. And the AEs are very trained. So they will work with you very closely to get that deal funded. And we're dedicated to your success. And we know that you're obviously, you know, your reputation is everything with your brokers. So that's important, very important to us.
Okay, now when you get your email from me, Rose Waldy, in about an hour, you included with the slide deck and the recording is this wonderful thing that I developed for you guys. And here's the link to how to get it. This has private label flyers on everything that we talked about today. So if you're excited about any of the programs that we talked today about the bank statements or condo tells, you can go in here, download emails, download flyers, download social media banners, put your logo on there, and you can start reaching out to your referral partners today. So I hope
it's free. Above all, it's free. You're using our marketing dollars for work, putting the work for you.
Exactly. So a borrower might qualify for asset depletion, bank statement, and DSCR. Which one would be more convenient in terms of pricing?
So when you're looking at bank statements and asset depletion or DSCR, we could be talking about, if it's a DSCR, we could be talking about a rental property. But if it's a primary residence, then that rules out DSCR. But in terms of pricing, a bank statement loan on a primary residence would have the best pricing overall. But a DSCR on an investment property, as Janice said, right now is pricing out the best for investment property versus going alternative doc income. So if it depends on the property type, and if it's an investment property 1 to 4 unit or a primary residence 1 to 4 unit, that's going to determine what is going to have the best pricing. Did I answer that correctly, Rose?
I think so. All right, I'm not sure.
That's a really good question.
Yeah, I'm not really sure if we can even answer this question, but I'll put it out there. Also, I have heard that rates in DSCR will be going up as the market is coming down. Is there any validity to this claim, and why would that be?
I can't really speak to that. I mean, my crystal ball has been foggy for years, so I don't know for certain on that, Rose. I mean, you know, we would have to probably take that one away and get back to you. But
send them in now. Let's lock them. Let's get them done. Let's take advantage while we can. I felt like I was on a roller coaster yesterday, and I said, please, someone get me off this roller coaster. We don't know, right? It is a volatile market. It could change.
True.
But just so you know, LendSure does not have a daily rate sheet right now. It's monthly, and with volatile markets, we might issue 1 or 2 during the month. So usually we do have just 1 month, so you could take advantage of that, start getting those loans in now. If they change later, well, we'll definitely let you know.
Very good point. Very well answered, Janice.
All right, on property taxes, do you use the current property taxes or do you use the estimated taxes after purchase according to the property appraiser?
We will be using the taxes according to the settlement agent, who is the professional and expert in that field. For example, if the current owner is an owner occupied, has a homestead in taxes, but we know this is an investment loan where homestead is not available, we relay that to our settlement agent, and we rely on the settlement agent to give us an accurate tax for our specific loan.
Okay, great. And will my AE be able to share a matrix or something similar for the LLPAs you have, i.e. short-term rents versus long-term rents, DSCR, LTVs, FICOs? Adam, send me, reply to the email with all the info that I'm going to send you in about an hour, and I'll send you the matrix that we have. And if there's any missing information, I'll definitely connect you with your AE and see if we can get any and all of your questions answered.
And Rob,
Um,
do you also want to talk to Spark? Because the Matrix will have our products and guidelines, but Spark is a great way for you to know a ballpark what your rate will be.
Yeah, so I think his name was Adam Rose. Is that correct? The question? Okay. So
yes.
yes, so Adam, on our website, lendsure.com, off to the far right, you will see something called Spark. That is our pricing engine. You do not need any credentials to log in and to run a scenario. You can run an investment property. You can even run pricing on a 5 to 10 unit as well. So DSCR, full doc, bank statement, asset depletion, you can run all of those. Primary, second home, investment, even a bridge loan, you can run the pricing and it will come out with multiple different products available to you. If you get green, on the right-hand side, you will see a list of products in green that are available, including a fixed rate 30-year, or maybe a 10-year IO with a 20-year amortization, or a 10-year IO with a 30-year amortization. So there's a lot of options available to you to run all kinds of scenarios, and you can even run multiple scenarios and put them side by side, and they will come out with the products side by side on the screen as well. So it's very intuitive. You can convert that to a PDF and email it to your borrower, your broker, or your AE to review the pricing with you and review Spark with you. But I would always recommend you reach out to your AE, because your AE can price it for you more accurately and maybe go over what we can get done as an exception. So if Spark returns something that gets denied, but it's a very low LTV, we may want to take a look at that deal. So, you know, if you're under 50 LTV, Janice, do you agree?
I agree, and I was going to say just one thing, Rob. It's a great tool that we are used to using. I get calls from clients, hey, it gave me a rejection, I don't know why. And I said, let's do this together. And sometimes it could be a very tiny exception that I know we will do, or it's like you're $1 over the max loan size for that, really, really little things. So don't let it discourage you if it does say no. But definitely reach out to your account executive. But it's a great tool, and to kind of go into what that other person was asking is, what's a better price? Income, DSCR, like, which you could actually compare, because it's going to give you investor income qualified and DSCR, and you could go in there and go, oh, okay, well, because I put the taxes, insurance, and the rents, it's not going to cash flow, I'm better off with bank statements. Right? Or it does cash flow, DSCR, easy peasy street, and it's going to be a better rate. Well, what's not to love, right? So there,
That's right.
You get a lot of options there.
All right. Catherine wants to know, do you offer a program where self-employed borrowers qualify using 1-year tax return?
Yes,
Yes,
we do. So
they do
we can,
still need
Rose,
to be self-employed 2 years.
that's right. That's right. Great point, Nicole. But we offer a 1-year 1040, 1-year 1099, 1-year W-2. So we have a lot of flexibility there to offer a 1-year full doc program, even 12 months bank statements, which is really only 1-year alternative documentation.
Okay. On construction loans, are they strictly full doc, or can you use bank statements?
No
So on
income.
construction loans, there isn't any income requirement for the construction loans. It's those are for investors only, like experienced builders. So on those ground up construction loans, all of that information is right on our website under our loan programs, and there's a lot of information there, and that's where you can even apply for a construction loan term sheet as well. But there really is no income requirement or DTI. There's no LE, no CD, no TRID requirements or waiting periods either, because that's a true business purpose loan.
Okay. Are we limited to how many non-warrantable reasons apply to one particular unit?
Good question.
That is a solid case by case. I will say that we have seen a loan that had litigation automatically non-warrantable, that where the litigation was a slip and fall and the insurance company was taking care of it. So we checked that box. We did make that exception. And then we learned that the investor concentration, it is a primary, say condos where it's almost all investor concentration. So there was maybe another deviation or exception, and we checked that box. We don't necessarily like a lot of exceptions in one, but we have done condos that may have more than one deviation to guideline. That would be a solid case by case scenario.
Okay. I'm not sure I understand the question, Julie, but I'll go ahead and ask it. Do you allow rental income for departing residents without landlord experience?
Yes, we do allow that to qualify. We do usually we use online data searches for what the market rent would be for that departing primary. And then we do 75% of that, which is a great question because it's another way that we use hybrid income to qualify and get you a higher purchase price as well.
Okay.
Great question. A lot of great questions, but we have the answers, folks. So keep them coming.
All right. Do you allow non-occupying co-borrowers on the asset depletion or asset qualifier loans if the
Yes.
co-borrower has the assets and the majority of income to qualify?
Yes, we have done those scenarios in the past. Again, depends on the full borrower profile, so both of the borrowers, but we have definitely done that before.
Yes.
Okay. And then do they have to be of retirement age to use the calculation on retirement accounts?
No. No, the retirement, they do not have, and that's a good point because I believe that's a requirement of Fannie Mae when you use their asset dissipation method. They do not have to be of retirement age. I think I said they could be 30 years old with a big 401k, but we're only going to use 70% of that gross amount and then divide it by 120 or 60, depending on if it's asset qualifier or asset depletion. Good question.
All right. Awesome. With that, I want to say thank you so much to everybody for joining us for today's webinar.
No more
That is
questions?
it. So, Rob, any parting words?
No, well, yes. So non-QM is really hot right now, folks. And remember, the non-warrantable condo buyer, the self-employed investor, the self-employed borrower that needs bank statements, these are all your same A-paper borrowers you see every day. We also have a great bridge loan that we didn't talk about on this program, but we do have many bridge webinars and it's on our website. And there's a ton of information about that on our website. So please give us a call with your scenarios before you say no. Come to LendSure. There's probably a good chance that we can do this loan, even as an exception, and we might price for it, but we're going to make the exception. So give us a call, and if it's a hard no and it absolutely is outside of our guidelines, we will let you know that immediately. Right, Janice?
Yes, that is. We get the hairy stuff out of the way. With your help and being upfront with us, we can tackle that up front so that your loan doesn't fall out at the end. With that said, I thank you so much for joining. Please do reach out to your account executive. If you don't know who it is, ask Rose, and one will be assigned to you if you don't have one. This is what we live for. This is what we're trained to do, to help you, right? Don't rack your brain and think, well, how am I going to do this? Really, give us your hand. We'll take it and we'll work through it together. And that's what I want to say. So thank you for joining.
Thank you, Nicole.
Yeah, thanks everybody for your time today. Hopefully you picked up whether it's a key phrase, a tip, a trick, a new qualifying method. That's what we're here for. Please reach out with your one-offs or even your general questions. We're happy to help, and we wish you all a very successful spring market.
All right. Thank you, everyone.
Thanks.
Thank you.
Bye. Thanks.